Thank you for joining us today on June 14th, 2022. I bring that up because it's pretty exciting right now out there in the economic and market world. So I just want to give you some perspective of when we're recording this. We're all ready for Cardinals baseball today at 12:15 as the partners are happy to be taking the staff back to the old yard for the first time in a few years. But we got work to do before that. So welcome Cody, welcome Jay. As I mentioned, pretty exciting out there right now. And we wanted to take a few minutes. It's been a few months since we talked about market volatility. So wanted to take some time today and kind of talk through what I'm going to suggest are the big three pain points right now for virtually everyone, right? It's inflation, it's interest rates, and it's our good buddy, the market. So I'd like to go through all three of these. Talk through, I know you guys are students of data, talk through the data that's out there, maybe why things are happening the way they're happening. I mean, I know we've said this before, these are all three individual things. It's kind of like our financial cornerstones, the way they work, inflation, interest rates, and the market, three individual things, but they are heavily, heavily intertwined. So I want to talk about the data and the why, what it means, and what our clients are supposed to do about it. Right? So let's kick it off. The first thing I will say before we get into this, we are in this situation we're in. It takes a little bit of courage and conviction. And I would suggest, which we'll talk about later, I know you guys agree, try to take emotions off the table because all of this we can address in a logical manner and put a strategy in place. If you're working with us, we already have a strategy that we're working towards to combat this. So we'll get through it. Let's start with the Data King, DK for short.
I like that.
Let's start with inflation. Cody, give us some data and some why about what's going on with inflation.
Yeah, inflation, that's probably been the big topic here. Well, let's start off what maybe inflation is. All it is the increase for increasing costs for demands or goods or services. Why are we having inflation now and maybe we didn't have it in like 2008 when we had the big quantitative easing going on? I think it has to do with how fast we did it. 2008, it was stretched out over many of years. 2020, 2021, it was basically like a year and a half to where all this new money flooded the market. So when I say new money, the Feds basically, they printed money. And they handed out to the citizens and to the businesses of the U.S. At the time, it was great.
COVID cash.
Yeah, so there's this thing they call the money supply, the M2 money supply. So it takes all the money out there. And when we essentially gave out $5 trillion with a T, trillion, it kind of what we'd say flooded the market with new money. So I heard this analogy and I'll use it here. So let's say we have 10 apples and let's say there's $10. So it takes $1 to buy one apple, right? So now let's say we still have those same 10 apples and now let's say there's $15. So now it's going to take $1.50 to buy the same one apple. And that's exactly what we got going on here. And when we have inflation like that and exacerbated with low unemployment, rising cost of all goods and services. The coronavirus did not help with any of that. It was kind of the kickoff of it, I guess you would say. And then the printing of the money, you combine all that together, and we have ourselves a nice little stew of inflation.
Yeah, 8 or 9% that's a stew.
Yeah, pretty hefty.
That's a piping hot stew, really.
Yeah. By the way, were the apples golden delicious? Those are my favorite.
I think they were Honey Crisp.
Okay.
Ooh. Yeah.
All right. So Jay, that's some solid data on inflation, and sadly, it's 8-9%, highest it's been, I think, year over year since 1980. Mm-hmm. What does that mean for our clients? What does that mean for our clients on a day-by-day basis? I mean, with inflation, yes, we see prices of goods and services going up. The increase in gas prices is part of that, but it's also another whole separate story.
Right.
All I know is, the amount of money that I'm spending, that you guys are spending, that our clients are spending on discretionary versus essential, that's an issue. So talk to me.
It's a big change, really, right? And it's different. It's, we had our own budget set for everything, and then not only did COVID mess it up, and then supply chain, so you couldn't buy the stuff that you wanted to buy, kind of messing it up. Well, now things are coming back in stock. You can purchase more things, but now it costs more too, on top of that. So, and then, we are seeing some wage growth, which is good as a country, maybe not individually. And all these different things are going to contribute to, you need to reevaluate what your budget looks like, right? Because you already mentioned gas prices, that's a big one, but also grocery prices have changed so much. Just looking at my own family households between gas and just groceries, we were talking about earlier, we probably just need to revisit our budget more often than we used to. When inflation's 1 and 2%, you could be pretty consistent from year to year. Well, when it's 8, 9% per quarter, you need to take a look.
Right.
Some big changes.
Right. So, and the one thing, and I know you have some data on this, but maybe share, because this is where, excuse me, where all three of these big pain points are kind of interrelated, particularly the market, right? I know a lot of times the immediate reaction is when I'm spending more on milk and butter and bread, I'm going to reduce my savings, which is a slippery slope. So talk to me a little bit about that.
Yeah, so I am not the data king, but I have some numbers here too to share.
Junior data king?
All right, I'll take it. So looking at some household savings rates, and I went back to 1980, and I tried to pick out some points that I thought were kind of interesting. So when they first started, the average household savings rate year over year was 11.4%. That's pretty good. I don't know if that kind of strike you guys as high or low.
I thought it was high.
High, but from a financial planning perspective, it's a fantastic number.
Right. we usually try and start at 10 as a household, right? And then try and go up to maybe 15, something like that, right? So that was pretty cool. Fast forward to 1990. So we got out of the high stagflation years and everything. And the rate was 8.8%. So still not bad.
Still solid. Yeah.
Still solid. Now you jump ahead to year 2000, get past Y2K, and then we get hit with the dot-com bubble. How about savings rate at that point? How about 4.2%?
Ouch.
Not really surprising if you think about it, right? There are lots of jobs lost. Nobody wants to keep money in savings at the moment because they're trying to live off of it, right? Fast forward 2007, right before December and the big drop, we're at 3.6, the lowest savings rate. Keep going forward, 2020, we talked about putting $5 trillion in. Jumps up to 16.3% as a nation savings rate.
Yeah, can't spend, save.
Right. And so that's one of the things that's different. A lot of people are comparing right now to the last time we had huge inflation numbers is, oh my gosh, this is the same thing. Well, not exactly. We have the last check-in was 11.9% savings rate as a country. We still have a lot of cash, to your point earlier, that we have in our savings. So we can weather this for a long time. I don't really want 8 and 9% inflation for a long time, but at least we can kind of weather the storm for a little while.
Super. And so let me paraphrase. What you're saying is, I'm hearing is let's not immediately rush and reduce our savings rate.
Correct.
I think for a lot of our clients that are still working, they're in their 401k plans, they have qualified plans that as long as they're doing a percentage of salary, don't change that. And in the near term, balance out essential versus discretionary if we have to tighten our belt somewhere.
Right.
Yeah. And again, it's not. We joked about it in the past. It's kind of we may as well joke about it because we're going to cry about it. It's obviously not transitory. That whole thing we laughed at that in the beginning.
About a year ago, yeah.
Yeah. Finally, Janet Yellen apologized. It's not transitory, which we already knew. So it's here for a while. There are ways to combat the impact, but let's not try your best not to rush to lower your savings rate, because when we talk about in the market in a minute, everything's kind of on sale.
Exactly.
Okay, so it's a good kickoff on our big three pain points. Talk about inflation. Let's now move over to interest rates. So DK, Data King, talk to me about interest rates.
Interest rates, yeah. So why is that in the news a lot? And well, first of all, I think that they had to go up at some point. You know, if we look historically at interest rates, we've for the last 12 years really been paying historically low interest rates, and especially when we got to late 2020, 2021. I mean, they hit rock bottom. You know, you get a 30-year mortgage at 2.5%, which a lot of people would love right now. But yeah, if we go back and look at, you know, what's the average mortgage rate been, and we had data from the St. Louis Fed Reserve that goes back to, I think it was 1975, and at that point it was about 7.5%. Late 70s, early 80s. Well, if you were in that, you know what happened. You were paying mortgage rates 12, 14, 15%. And then since then, it's been on a kind of a downward trend. Now, we have had a big spike happen recently with the interest rates going up. And I think it's the expectation that there's going to be a lot more interest rates to come down the road in kind of a short period of time. You know, we were sitting here a year ago, we were saying, you know, probably would be a good time to maybe stretch these out over a period of time, so people could maybe get used to it. And now it's just going in and they're saying, yeah, let's do 50 basis points here, let's do another one in the next month, and we'll see where we're at. And with the expectation that they're probably going to continue to raise rates through the summer, and they use the term front loading, meaning, oh yeah, we kind of let inflation get out of hand a little bit, so we need to pull in the reins a little bit faster than we thought. So it's you know, no matter what you're in, equities and bonds, it's been just because of the interest rate threat and the inflation we're having, and it hasn't been a good start to the year.
All right. So, and again, I think it's fair it would have been nice if the Fed would have started this a year ago. They didn't. As we sit here today, getting ready to go watch some Cardinal baseball in 110-degree heat. There's talk of a 1% increase potentially tomorrow when the Fed meets. You know, again, inflation's running, so now they're trying to rein it in. I think we're trying to play catch up. That all sounds fine and well on TV when we hear that stuff, Jay. But what does it mean to us, to our clients? This whole interest rate thing and the Fed playing around trying to rein in inflation, where does that hit home for us?
Yeah, for us, it goes back to our budget. It goes back to all of the different obligations that we have to run our households, right? So you're talking about mortgage rates and car loan rates, credit card rates. It's going to affect rent. It's going to affect property taxes. It just affects every part of what we're doing. So to use some more data, going back to 1980, if you look at a household and how much they're spending towards these financial obligations, right? So everything I just listed off. Back then it was around 15.4% of their income was towards these different things. Well, that was a very, very high inflation period, right? Just after that, towards the end of the 80s, 1989, it jumped up to 17%. That's when it kind of maxed out because we had high interest rates, inflation was starting to slow down, and we're getting ready to go into a boom in the market, right? So with that was the max. Fast forward again to the same dot-com bubble burst, and that's when it was around 16.5. So you can see that's kind of the window of where our debt usually as a country has been, is right around 15 to 17%. But then 2007 jumps up to 18. So we had low interest rates, and we all know what happened with mortgages and giving people mortgages they didn't really need, deserve, qualify for. So anyway, that's kind of the absolute max at that point. Keep going, I'm trying to add perspective. Here's what I'm trying to do, right? If we go to 2021, you already told us we had the lowest interest rates on mortgages at that point. The Fed basically cut rates to zero. As a country, we were at 12.6% at that point of our financial obligations as compared to our income. So really low. That's why this time is a little bit different because we have cash and because interest rates on our good debt is pretty low. So what do we need to do? We need to reevaluate, hey, what's the timing of these next purchases? Because if interest rates are going to go up, does that mean we need to be looking at making it now versus later, or accept the higher interest rate? Are the rates going to come back down? Those things we don't know, and it's really super individual of what you should be doing. But that's kind of what we're looking at for right now.
Yeah, so let me ask you guys, and either one of you can dive right in. Let's go down that path, and I'll start with you, Jay, because Megan's in the real estate business. We have clients that are looking to their family's growing. They want to buy a bigger house. We have clients that are retiring that want to downsize.
Right.
So how do we help clients manage and navigate that decision of wait for real estate prices to come down or dive in now at a higher price while mortgage rates are still seemingly manageable?
Right, because if you look at it, it's kind of a double-edged sword. Which one do you want? It's not ideal either way at the moment. And so that's where we were kind of talking before we pressed record here. Well, what do we really need to do? You need to look at it as more of how long are you going to be in said house? If we're going to be in there for a long term, then okay, it's probably okay to accept we're going to pay more at a lower interest rate, right? Because you're probably, we could do the math, probably will end up paying less long term with lower interest rate, even if you pay more. But on the flip side, if maybe you need to transition in a couple years and or something could change or a job change or something like that, well, then you might want to consider holding off on that purchase because you're probably going to end up paying more on costs than you're going to save than purchasing. So,
gotcha. Cody, any additional perspective on that?
Yeah, I'll go with Jay. It's the longevity of the expectation of how long you're going to be in there. So you got either I'm going to, a lot of people will say that maybe home prices are overvalued. I don't know if I'd use the term overvalued a lot, but I think they're a lot higher. They came up a lot quicker than everyone anticipated. And then on the flip side is, okay, if you're sitting here today and you're going to say, over the next year I want to buy a house, then you got to really think of, and you really should look at some amortization tables. We can walk you through the math and all that. But it coming down to just a difference between paying 5% and 6%. The numbers, the cost of servicing the debt starts to get pretty expensive. I don't know about you, but I fully expect probably a year from now it's probably going to be at least 1% higher. So that's where the longevity of it comes. Do I want to service a higher ratio of debt for 30 years, or do I want to pay a little bit more upfront for the cost of the home, but have a lower servicing debt over 30 years?
right.
Gotcha. Super. All right. Let's go to our third pain point, the market. Right?
Market.
So we'll go back to you, Data King. Give us some initial data on the market, and then let's chat about that a little bit.
Yeah, so, we, at the beginning of the year, especially when we were doing reviews last year, hey, the market's been doing really well. It recovered good from COVID. As we start to see the inflation numbers come through, okay, well, that usually has some sort of short-term downturn on the market. Well, here we are with the short-term downturn that we're sitting with. Especially the last week or so hasn't been very kind. If we look at what the S&P is doing right now, we're right on the edge of bear territory. It's hovering around negative 20%. We look at the NASDAQ, it's about negative 30%. We look at bonds, what are going on with bonds? Believe it or not, it's down about 10%, 13% for corporate bonds. So, it kind of feels like, well, wherever I have my money right now, I seem to be down. So, yeah, that would certainly be the case. A couple things I'd have to say with that is to make an emotional decision saying, well, if inflation continues to go up, that doesn't necessarily that the market continues to go down. Right. The market is a forward-looking instrument, so we need to take that into perspective. And at the same time, adjust, okay, well, what is my appetite for risk? Am I too risky that when the market goes down, I don't enjoy the pain of it? Not everyone's going to enjoy the pain of it, but it's, can you tolerate it being down that much? Can you tolerate the volatility in the market? I would have to say with the bonds, because of how quick the short-term interest rates have gone up, and how we position majority of our clients' portfolios with short-term bonds right now, I feel like a lot of that pain has already been put in to the bond prices now. So for me, I'm like, okay, we're over that hump. Brighter roads ahead. The equity portion, we go back and compare what happened in the 80s after we came out of this high inflationary period. The S&P had one of the best runs that it's ever had. Will that happen here? We're not certain, but I do feel optimistic for the year to end up higher than where it is now.
Right. Yeah, and Jay, I would offer up, excuse me, and this chart, and I think we used it a couple of months ago, but it's from our research partner at JP Morgan, goes back the last, I believe, 42 years, and shows a sample 60% equities, 40% bond and cash portfolio was actually positive 35 of those 42 years. Right. And again, they're using indices to measure that. But what I found was so interesting, I know the three of us talked about it, is that the average intra-year, within a year decline, not how it finished at the end of the year, the average was nearly an 8% drawdown on that portfolio within a calendar year over 42 years. Right. So with all of that data, what do clients do with that?
Yeah. So, Cody already said it. It doesn't feel good, but this is probably a short-term type of an event. This is probably going to recover. Cody's optimistic. We're going to end up higher. I am too. I share the same feeling. So what do? Well, you buckle in. I feel like we say the same thing every time, but it's because it's true. It's what we always say in our client review meetings. We have a strategy. We built a strategy around your individual situation, and it's trying to take the least amount of risk to achieve your financial goals. Well, with that, there still is a little bit of risk of going down. We're in the downtime, but that doesn't mean all hope is lost and we need to try and change the strategy midstream, right? Just accept that this is part of the ride. This is the bumps of the ride, and that someday it will turn around and be all good again. Right. So don't try and overthink it or get emotional too much about it. It's no fun. I mean, my money's in the market too. My accounts are down just like everybody else's, and I haven't looked at my 401k and I don't know how long. But that's what I do. That's what I'd recommend to the clients do the same way. Is it's okay to check in, but understand this is just part of investing, and that this is short term. For the long term, we all are optimistic that it'll turn around and want to look at our statements again.
Sure. And the one thing I would jump on, and all it's very well said by both of you, is that this is part of investing. Volatility is part of the deal. Right. I know we've gone for a couple years without volatility, and then as we've talked to our clients about, you get to this year, and there's a lot of things going on in the U.S. and outside the U.S., and it felt creepy, right? But if you look back in history, volatility is part of how the market works. And quite often I'll get the question, should I sell out, right? And I always answer that by saying it's a two-step decision. If you go to cash, when are you going back in the market? Mm-hmm. And historically, you can run all the math and use all of our research partners. We're better off with a defined strategy where we're controlling risk, and then we all collectively work together to not do stupid things, like go to cash, because then you'll never go back in. It'll never be the right time. So accept volatility as part of what comes with being an equity investor and what comes with capitalism. Things go up and down. But as I always joke, I haven't gotten the memo yet that they busted capitalism. So until I get that, we're going to remain disciplined in the approach of our portfolios and really help our clients eliminate emotion. Okay, so those are the big three pain points, right? It's painful on inflation, whether it's gas or grocery prices. It's painful on these interest rates, particularly if someone's looking at buying a home, and obviously trying not to watch the market and 401k statements, investment statements, very painful. All three separate things, but all closely interrelated. Final thoughts?
Yeah, I'd say timelines is what kind of pops into my head for if you're out there looking to purchase a home, and in the next year that's probably going to happen. it would be a good idea to talk to your financial advisor just to go over the math and so you understand actually how loan interest works and how it's amortized and how you pay the bank basically up front, and the longevity of how long, what Jay talked about, how long you're going to be in that home. It's usually the biggest purchase you make in your financial life, so it's important to make sure that you understand the inner workings of it and the options you have with that. Another thing, inflation, yes, it's not like next month it's going to go down to 2%. That's kind of our target inflation. It will take time to hopefully level off. That's what we were looking for at the beginning is, can we levelize it, and then can we see it start dipping? With gas prices up like they are, that's the biggest. Gas prices and rent are the biggest indicators of what moves it the most. So as gas prices stay high, which they probably will throughout the summer, let's look for the leveling off of the inflation. That will be good news for the market. And if we start seeing it tick down, I think the market will react positively to that.
Super. Jay, what do you think? Final thoughts?
Yeah, so I was going to piggyback on what Cody was just saying. Everything we're talking about is big level, but we often try and bring this down to client level too, right? And make it specific to you. So if this is super uncomfortable, more than you're comfortable with, reach out to us and we can sit down and talk through it. And also, if you're watching this and you have family or friends who are talking about these things and maybe don't have someone to talk with, send them this video, reach out to us. We're happy to sit down and talk through it. But these are the times when I feel like we provide the most value, because it is so uncomfortable. It's hard to watch your statements, right? And just know that you're doing the right thing. So reach out to us.
100%. And as I said in the beginning, these are times, it's not uncommon that we have inflation, interest rate issues, and market issues. It just doesn't happen very often, right? And as I said in the very beginning, these are times to take a little bit of courage and conviction to stay the course and not let emotions kind of run amok, right? And Jay, I agree 1,000%. It's easy to be in this business when everything is good and interest rates are low and there's no inflation and the market's running up. It's easy, right? Where the challenge comes in this business is, again, when we get in this situation, we're talking about money. People get really emotional. And it's our job to help them separate emotional decision-making from sound, rational, long-term effective financial decisions. And I joke all the time with our clients, and you guys have heard it because you've been in the meetings. It's really easy for me to be unemotional about our clients' money. That's my job. But when I start talking about my money, I'm going to be wildly emotional, and our clients would be unemotional talking about my money. So that is really the issue, and thanks for saying that. If you have any friends or family who have expressed concern or facing issues because of these big three pain points, share the video with them. Give them our phone number, give them our email, give them the chat line. Happy to talk to anyone with no expectations, just to kind of bring them back to reality. We will see the other side of this. It's a question of when. We will see improvement in all of these things. They may come dramatically, they may come over time, but it will improve. So thanks for taking the time. A little bit longer today than normal, but with these three big pain points, we felt like it was appropriate. Again, give us a buzz if we can help you or any of your friends and family in any way we can. And thanks to Cody, thanks to Jay. Go Cardinals. We'll talk to you guys next month.